Welcome back. Boyce, Goff is back with us. Boyce, you're just getting over your crazy season in the tax world.
Oh, yeah. It was pretty crazy this year.
Yeah, well, I guess half the people are paying taxes, right?
Well, somewhere in that neighborhood.
Can you have any insight as to why people think it's only half? Is that an age thing?
You mean when you say half the people are only paying taxes, you're talking about across the total population?
Yeah, that's the new numbers people like to throw around. Oh, only half the population pays taxes.
I don't necessarily agree with that. Of course, my client base is more of a higher income base, and they pay their taxes. I mean, how many of them walk away without paying anything? At the level of the incomes we're dealing with alternative minimum tax and things like that. Even if it's not earned income and it's dividend income and preference income and things like that, they end up paying their taxes.
I just figured it's because there's a lot of 5 and 6 year olds who just don't have to file tax returns yet and don't have income.
Well, I wouldn't necessarily count them in the taxpayer population.
Well, that's there. I think they get their numbers, but hey, they'll revise it. Don't worry. Next month.
Oh yeah,
Boyce. So tax season's over. I love having you here because you really take a different approach. I always, a lot of people consider taxes looking in the rearview mirror. You take it from a looking forward approach. Let's talk about planning for 2012 to pay less in 2013.
Well, let's say, for example, I know that you're in the real estate business, in the mortgage business, and one of the things that you need to be looking at is if you're buying a new house this year, whether it's your first home or you've sold another home and you're buying a new one, you really need to look at your W-2 or your W-4 and see how many exemptions you're taking, and compare that to the amount of interest deductions, property taxes, and things like that you're going to have to pay, and adjust your W-4. Look at the rest of your exemptions, your charitable contributions, and adjust that W-4. And people say, well, why is that? Well, the reason is because then what happens is that refund that you would normally be getting is coming to you on a month-to-month basis. And so I know that you and I can spend our money better than the government. So why give the government an interest-free loan for a year? Why not give that to ourselves and, pay down our credit cards?
Or not even have a credit card.
Or not even have a credit card. Or do whatever we need to do. And it's what I call it is just repositioning your assets as opposed to giving them Uncle Sam. Why don't we put them in our own pocket? And so that's one of the big things this year when we were going through doing the tax returns for our clients. We were just looking at it and saying, if you got a big refund, here's an adjusted W-4, give it to your employer, and start getting that refund in your pocket.
So when people go, this is a big point, and this isn't always just going through the fall, year to year, but or buying a house. This is something you can do year to year when you get a raise. This is kind of anytime an income changes, you should be talking to your accountant.
Absolutely. And one of the other things, too, is look at it from that standpoint once you do your exemptions, is, you run into a lot of clients people who work for very good companies that have very good 401k plans, and they're not maximizing. Of course, you run into a lot of people that say, well, I'm only going to maximize it to the extent that the company matches. Well, my response to that is crazy. What you should do is if you've got the money, max it to the limit. And the reason being is Uncle Sam is subsidizing you to put that money in. So if you're in the 33% tax bracket and you put away $17,000, a third of it, Uncle Sam is handing you a check for a third of that contribution. Why not? And, then the cash flow, again, is repositioned into your pocket.
So when you start looking at a lot of this, and looking forward, a lot of it is more of almost a monthly cash flow management piece. This isn't really refiling a tax return, this is kind of basic cash flow management in order to lower your tax bill in the future.
Absolutely. Repositioning the cash that you're spending. It's one of the things that we sit down with a lot of our clients that are high income, high net worth people, particular professionals, doctors, dentists, lawyers, and people like that. And we sit down and we say, look, how much do you need to really live on a month-to-month basis to meet the nut? Pay your mortgage, pay your car payments, take the kids to school, take a vacation. So at that point, we sit down and we look at that amount of money, and then we extrapolate it back and say, this is what your W-2 should look like. Let's put you in a corporation. Let's pay you a W-2. The rest we're going to hold in the corporation. We're going to build up a cash amount. We're going to fund your retirement plan, which you haven't been doing in the past. One of my dentist clients that I'm working with right now out of South Carolina, in 2010, his tax liability all included was about $90,000. Well, this year for 2011, because of the planning that we're making, his tax liability is $22,000. Now, he's going to be able to fund into his retirement plan for him and his employees $89,000. Well, between the Fed, the government, U.S. government, and the state of South Carolina, he's getting a 50% tax savings on his taxes. So basically what the government's saying to you is we're going to give you a $45,000 check. Hey, I'd much rather put that in my pocket than give it to somebody else.
Yeah, I'd rather put it in my pocket too, Boyce. You'll let me know when that check comes to me, and I'll be sure to put it
I think
there.
I've already told you how to do that.
We're here with Boyce, Goff. Boyce, we have about a minute left before we have to go to break, but I really think this sounds, whether it's retirement planning, which a lot of this is this just an element of knowing what to do with the money and when to do it?
Well, first of all, yes. And I think that's very important. Of course, I don't care what anybody says. Yes, you can go on the internet and look at it and try and learn it for yourself and all this other stuff. And you can use TurboTax and you can go and do personal financial plans. But, our previous speaker, the bottom line is that sounds great. But again, it's one of those things.
Well, knowing where to put it is also...
That's the most important thing.
But that's also knowing how the 400,000-page book about taxes is written. I mean,
well, it's a little more than 400,000 pages.
Oh, yeah, I heard they increased it this year, didn't they? It's massive. Right? Yeah. So it's also knowing what to do, I guess, how to effectively place that
Absolutely.
money. And it's tough to do. I mean, if you're, a person who doesn't do taxes every day...
And don't believe that you're going to be able to sit down and figure it out by yourself by reading some book or something like that, because you don't understand the intricacies of the tax law. I picked up a client the other day that I'll do my tax return and everything else, and I said, fine. When you're done, send it to me. Well, already we've picked up another $5,000 or $10,000 worth of deductions for her that she just didn't take care of.
Well, once again, that's a lot of money, and if she needs a place to send that and she doesn't want to send it, the government doesn't need it.
Well, I keep
my
trying
pockets
to
are wide open here, wide open.
I keep trying to get them to payee, U.S. Treasury, BOYCEGOF. It doesn't work.
Boyce, thanks so much for joining us. We're going to go to break. Heather Moore is going to join us when we come back. We'll be right back after this break. You're listening to Brashenomics.